The biggest risk in global markets right now isn't stocks, AI, or geopolitics. It's US debt, and the trigger may be rising Japanese bond yields. For years, the United States has been able to run massive deficits without immediate consequences. Trillions in Treasury issuance were absorbed smoothly by global demand. Interest costs rose, but markets stayed calm. That stability rested on one key assumption: foreign buyers would always be there. That assumption is now being challenged, starting in Japan. Japan has been the world's largest exporter of cheap capital for decades. Ultra-low yields allowed Japanese banks, insurers, and pension funds to buy U.S. Treasuries in enormous size, quietly suppressing U.S. yields and financing America's debt at low cost. That support is cracking. As Japanese yields rise, capital that once flowed outward is being pulled back home. The yen carry trade, borrowing cheaply in Japan to invest abroad, is no longer safe or profitable. When funding costs rise, global liquidity tightens. This is where America's problem begins. The U.S. is issuing debt at a historic pace while refinancing old debt at much higher rates. This only works if demand remains strong. If Japan, a cornerstone buyer, steps back or starts selling, yields don't drift higher. They jump higher. Higher yields don't just hurt bonds. They ripple through the entire system. Equity valuations come under pressure. Mortgage rates rise. Credit tightens. Government interest costs explode. At that point, debt stops being abstract and becomes a market risk. Japan is not causing America's debt problem. It is exposing it. Bond markets always move first. Stocks react later. By the time this becomes a headline crisis, yields will already have reset higher and policymakers will have fewer options left. The US debt bomb didn't appear overnight. But if Japan's era of ultra-cheap money is ending, the countdown has clearly begun.